Greetings and welcome to the lesson. Today we are going to study the topic tax planning. My colleague introduced the topic during the last lesson, where he took you through the tax planning for individuals by way of tax exemptions, tax exempt activities, transactions that are allowable expenses, and transactions attracting tax set-offs. He also illustrated the subtopic tax planning for individuals by solving a question. Today, we will consider tax planning for body corporates. Tax planning for body corporates. In this lesson, we're going to highlight some of the tax planning strategies for body corporates in Kenya. And by now, you know that tax planning is a process of organizing the financial affairs in a way that minimizes tax liability. So if it is for an individual, then tax planning would be the process of organizing the individual's financial affairs in a way that minimizes tax liability. And it involves making strategic decisions. It involves utilizing available tax provisions, deductions, credits, and also exemptions to legally reduce the amount of taxes owed to the government. And candidates, tax planning is not about evading taxes or engaging in illegal activities. Rather, it focuses on optimizing your financial situation within the framework of tax laws. It involves careful consideration of various financial elements, such as income, such as investments, such as deductions, expenses, and even it may consider the timing of transactions with the goal of maximizing or minimizing after-tax income or assets. You understand? It is not an illegal activity. Tax planning is simply the process of organizing financial affairs so that the tax liability of an individual is minimized, or the tax liability of a company is minimized. And in this lesson, we will study the strategies that could be available for body corporates, particularly the ones in Kenya. So by the end of the lesson, you should be able to highlight tax planning strategies for body corporates in Kenya. Now, what are these strategies? Tax planning strategies for body corporates. The first one is simply understanding the Kenyan tax landscape. Understanding the Kenyan tax landscape. What does that mean? Now, candidates, body corporates in Kenya are subject to corporate income tax at the rate of 30%. Additionally, these corporates may be liable for other taxes, such as withholding tax, value-added tax, and even stamp duty. And understanding the Kenyan tax system and staying updated or any changes is essential for tax planning. It is essential for tax planning. Understanding the Kenyan tax landscape or tax system is essential for tax planning. The second point, maximizing deductions and exemptions, maximizing deductions and exemptions. Now, Kenya tax law allows various deductions and exemptions that can reduce a company's taxable income. And common deductions include expenses incurred in generating income, such as rent, utilities, employee salaries, and so on. Exemptions, on the other hand, may include certain types of income, such as dividends received from resident companies, and so on. So by maximizing deductions, by maximizing exemptions, then a company's tax liability can be minimized. 3, timing income and expenses. Timing income and expenses. Now, strategic scheduling of income or strategic scheduling of expenses can significantly impact a company's tax liability. For example, deferring income to a year with a lower tax rate or accelerating expenses to a year with a higher tax rate can be beneficial. The company's affairs can be arranged in such a way that income can be deferred to a later year and expenses can be accelerated so that they are incurred in a year with a higher tax rate. All right? That can be beneficial. That can reduce the tax liability of a body corporate. The third strategy of reducing tax liability for a body corporate is in relation to structuring business operations. Structuring business operations. Structuring business operations. Structuring business operations. We are talking about legal structure of a business that can influence its tax implications. In Kenya, common business structuring could include or business structures or forms of business could include sole proprietorships, partnerships, limited liability companies, corporations, and so on. And each form or each structure has its own tax advantages, has its own tax disadvantages. So careful consideration may be necessary in order to reduce the tax liability of a body corporate. Structuring business operations. 5, utilizing tax credits. A body corporate can reduce its tax liability by utilizing tax credits. And candidates' tax credits are direct deductions in a company's tax liability. A tax credit reduces the company's tax liability. And there are various tax credits available in Kenya, such as investment tax credit, such as training tax credit, and so on. So exploring and utilizing these credits can significantly reduce a company's tax liability. 6, seeking professional advice. Seeking professional advice. This can be a strategy in which a company can use to minimize its tax liability. And how is that possible? That is possible by the fact that due to the complexities of the Kenya tax system, seeking guidance from a qualified tax advisor is highly recommended, because tax advisors can give or provide tailored advice. They can assist with tax compliance. Tax professionals can also help companies navigate the landscape, the tax landscape effectively. So seeking professional advice can be of great help in reducing a company's tax liability. 7, maintaining proper records. Maintaining proper records. Proper records. Now, accurate and organized financial records are crucial for effective tax planning and compliance. Companies should maintain proper records of income, expenses, proper records of assets, in order to support their tax positions and also to ensure accurate tax calculations. So if that does not happen, then a company may end up paying high taxes or low taxes than is required to pay, which may attract penalties. So it's important for a company to maintain proper records of assets, proper records of expenses, proper records of liabilities, so that the calculations are accurate. That is one way to reduce tax liability. Staying compliant. Number 8, staying compliant with tax laws. Staying compliant with tax laws. Failure to comply with Kenya tax laws can result in penalties, can result in interest charges, can even result in legal action. And companies should adhere to all tax laws. Companies should file returns. Companies should adhere to the tax filing deadlines and make timely tax payments and keep accurate records to maintain compliance. That is number 8. Number 9 is reviewing tax strategies regularly. Reviewing tax strategies regularly. Reviewing tax strategies regularly. The Kenya tax law or system is subject to changes. The Kenya tax system, the Kenya tax laws keep on changing. The Kenya tax laws are dynamic, right? And companies should regularly review their tax strategies to ensure they are aligned with the latest tax laws and regulations. And that it may involve seeking updates from tax authorities, seeking updates from tax advisors, reassessing the effectiveness of existing tax planning strategies, and so on. By doing so, a company can reduce its tax liability. By doing so, the company will be putting in place proper strategies for tax planning. Reviewing tax strategies regularly. Number 10, leveraging technology. Leveraging technology. Tax software and online resources can streamline tax compliance and planning processes. So companies can utilize such tools to manage their finances, to prepare tax returns, and even stay informed about tax updates. So these are 10 strategies. 10 strategies for tax planning for body corporates. Number 1, understanding Kenyan tax landscape or system. Number 2, maximizing deductions and exemptions. Number 3, timing income and expenses. We've explained how that can play out. Number 4, structuring business operations. Number 5, utilizing tax credits. Number 6, seeking professional tax advice. Number 7, maintaining proper records. Number 8, staying compliant with tax laws. Number 9, reviewing tax strategies regularly. And lastly, leveraging technology. These are 10 strategies. And candidates, by implementing these tax planning strategies, body corporates in Kenya can effectively manage their tax obligations. They can enhance their financial performance and achieve sustainable growth. So that will mark the end of the lesson. In this lesson, the objective was to highlight tax planning strategies for body corporates, and we say that by the end of the lesson, as a learner, you should be able to outline the tax planning strategies for body corporates in Kenya. Before we close the lesson, I'm going to give you assignment. I'm going to give you today's assignment, tax planning. Question 1. What are the current tax incentives and exemptions available for body corporates in Kenya? And how can organizations leverage these incentives for effective tax planning? Number 2, how does the recently updated tax legislation in Kenya impact the tax planning strategies for body corporates? And what steps should be taken to ensure compliance with the new regulations? Number 3, what are the considerations for transfer pricing in the context of tax planning for multinational body corporates operating in Kenya? And how can organizations ensure adherence to the arm's length principle? Number 4, in the context of value-added tax, what are the specific opportunities and challenges for body corporates in Kenya? And how can organizations optimize their VAT position through strategic tax planning? These are 4 questions. Please attempt them. If you have a problem answering the questions, you can write to us. Thank you for attending. I hope to meet you in our next session where we continue to study matters relating to taxation. Bye-bye.